For 6 years in a row, Fortune magazine named Enron the most innovative company in America. It had 20,000 employees, $111 billion in reported revenue, and a stock price that analysts across Wall Street could not stop telling you to buy. In the year 2001, Enron was the seventh largest company in the United States. It was also completely fictitious. Kenneth Lay founded Enron in 1985 by merging two natural gas pipeline companies. He built it into an energy trading giant by convincing regulators to deregulate the natural gas market. Jeffrey Skilling, a Harvard Business School graduate and McKinsey consultant, joined in 1990 and transformed Enron from a pipeline company into something far more dangerous. He convinced Lay that Enron should not be in the business of owning assets. It should be in the business of trading them. That idea became the architecture of the fraud. The scheme was built on a legitimate accounting method called mark-to-market. Under this rule, a company records the estimated future profits of a long-term contract on the day it is signed, not when the money actually arrives. The SEC approved Enron's application to use this method in 1992. What Enron did next was abuse it systematically. They would sign a deal, book the full projected profit immediately, and then quietly hide the fact that the actual cash never materialized. The numbers on paper bore no relationship to the money in the accounts. When the projected profits failed to arrive, Enron needed somewhere to hide the losses. They created over 3,000 shell companies called special purpose entities. Each one existed only on paper. Each one was designed to absorb debt that Enron did not want appearing on its own balance sheet. Some of these entities had names drawn from Star Wars characters: Chuko, Jedi. They were run by Enron's own chief financial officer, Andrew Fastow, who secretly earned $45 million in management fees from the very entities he created to hide Enron's losses. Between 1996 and 2000, Enron's stock price rose from $20 to $90 per share. 16 major investment banks had analyst teams covering Enron, and virtually every one of them had a buy or strong buy recommendation on the stock. The reason was simple and corrupt. Those same banks were earning hundreds of millions of dollars in fees from Enron's investment banking business. Issuing a sell recommendation would have cost them the relationship. So they kept telling their clients to buy, even as the internal evidence of fraud accumulated. Enron's trading operations were real and genuinely profitable. The company created Enron Online, the first major web-based commodity trading platform, which processed over $350 billion in transactions in the year 2000 alone. But the trading profits were never enough to sustain the fiction the accounting department was building. The gap between what Enron reported and what it actually earned kept widening, and more shell companies kept being created to fill it. In August 2001, a vice president named Sharon Watkins sent a memo directly to Chairman Ken Lay. She wrote that she was incredibly nervous that Enron would implode in a wave of accounting scandals. She described the shell company structures in detail. She identified the specific risks. Lay forwarded her memo to Enron's outside lawyers. The lawyers advised that Watkins could legally be terminated. Meanwhile, the shredding had already begun. Weeks before federal investigators arrived, tons of documents were destroyed at Enron's offices and at its accounting firm, Arthur Andersen. In 2000 and 2001, California experienced rolling blackouts affecting millions of residents. The official explanation was a shortage of electricity supply. Internal Enron documents later revealed a different story. Enron traders had deliberately manipulated the California energy market using strategies they named Death Star, Fat Boy, and Get Shorty. They artificially created congestion on transmission lines, then charged the state to relieve the congestion they had caused. California paid an estimated $30 to $45 billion in excess energy costs during the crisis. Enron's traders laughed about it on recorded calls. In October 2001, The Wall Street Journal published an investigation into Enron's relationship with its own chief financial officer Andrew Fastow and the shell companies he controlled. The article raised direct questions about conflicts of interest. Enron's response was to fire Fasto and attempt damage control, but the article had triggered a chain reaction. Credit rating agencies began reviewing Enron's debt. Banks began calling in loans, and investors who had trusted the analyst recommendations began reading the footnotes of Enron's financial statements for the first time. On October 16, 2001, Enron announced a third-quarter loss of $618 million and a $1.2 billion reduction in shareholder equity. It was the first public admission that the shell company structures had real consequences. The stock had been at $90 in August. By November, it had fallen below $10. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. 20,000 employees lost their jobs the same day. The most devastating losses were suffered by Enron's own employees. The company had encouraged workers to invest their retirement savings in Enron stock through its pension plan. At the same time, executives were selling their own shares under insider trading protections. When the stock collapsed, employees who had followed the company's advice lost everything. A warehouse worker named Charles Prestwood had accumulated $1.3 million in his retirement account over 33 years at Enron. After the collapse, it was worth $8,000. In May 2006, Kenneth Lay and Jeffrey Skilling were convicted of fraud and conspiracy. Skilling was sentenced to 24 years in federal prison. Lay was convicted on 6 counts of fraud and 4 counts of bank fraud, but died of a heart attack in July 2006 before sentencing. Arthur Andersen, one of the 5 largest accounting firms in the world at the time, was convicted of obstruction of justice for shredding Enron documents. Although the conviction was later overturned on appeal, the reputational damage was terminal. Arthur Andersen ceased to exist. Congress passed the Sarbanes-Oxley Act in July 2002, just 7 months after Enron's bankruptcy. It was the most significant reform of American corporate governance since the Securities Act of 1933. For the first time, CEOs and CFOs were required to personally sign and certify the accuracy of their company's financial statements. Knowingly certifying false statements carries a prison sentence of up to 20 years. Independent audit committees became mandatory for every public company. Loans from companies to their own executives were banned. The act exists because of Enron. Every public company in the world that operates in U.S. markets operates under its rules today. Enron destroyed $74 billion in shareholder value. 20,000 people lost their jobs. One of the world's largest accounting firms was eliminated, and the United States rewrote its corporate governance laws. The tragedy is that every warning sign was visible for years before the collapse. The accounting was too complex to follow. The profits were too consistent to be real. The analysts covering the stock had obvious conflicts of interest. But the money was flowing, the stock was rising, and nobody wanted to be the person who asked the question that stopped the party. That is usually how these frauds survive as long as they do, and that is why they are worth investigating. That is what this channel does.